From Gen Wealth Financial Advisors, it's the fastest 4 minutes in investing.
Well, we had some surges in the market, followed by, John, recently it's been a little bit of a choppier course, some downturns this week. And when we talk about 2021, we're still in the last couple of days of the first month of the year. But I think optimism is still reigning when it comes to the economy and markets over the next 12 months. However, there are some potential concerns. And I think we're going to talk about one of those today. We are seeing some effects of how this might play out, but we're going to start with LPL's research on historical data, what happens with interest rates after they've declined, historically have been followed by a reversal.
Yeah, and that reversal usually is pretty significantly up. And, of course, we've been through a period of time when the Fed basically took interest rates to zero. If you think about how you can refinance a house right now in the 2 to 3% range, depending on your credit score and that type of thing, rates have never been this low. But what we are probably going to see is those rates bounce back up. And Scott, the interplay between interest rates and inflation is really kind of one of those things that's kind of hard to understand. But let's kind of go to school on this for just a second. When you have all of the cheap money in the economy that we have right now, that causes people to spend more money, and it enables the expenditure of money when it otherwise wouldn't be spent. Well, obviously, when there's a lot of money in the environment and sales are actually easy, then companies can raise their prices. We see this going on right now in the housing market. We see it in the building materials market. There are a lot of things that have been inflated because, number one, there's cheap money, but number two, there's also a short supply. Some of that is COVID related. Yeah. And so what we're kind of cautious about right now is an uptick in inflation. And an uptick in inflation is a hard thing to deal with. And the Fed tries to keep that inflation in check. Sometimes if the Fed is not quick enough on the draw to tamp down inflation, inflation can get out of control. And I'm not, in any way predicting hyperinflation at all, but I do think that we've been kind of lulled to sleep with low inflation rates over the years. And now that we're at the bottom of the interest rate market, that interest rate market is going to go back up. That has a consequence for inflation. It also has a consequence as far as bond investments are concerned.
Yeah, generally thought of as the dampener or the safe part of a traditional portfolio. If you are in fixed income and you are in a bond fund, now, again, that's the difference, and that's what most people are in, right? They're not normally in holding an actual paper bond, which if held to maturity, it's still safe money. You clip that coupon, everything's good. But in a bond fund, when interest rates start to go up, the value of the bond holding goes down. And so if you trade it, you could actually have some negative returns.
Yeah. So if you think about duration, how long a bond fund basically holds its bonds or the duration, the maturity of those bonds, if that duration, let's say, is 10 years, then if interest rates go up by 1%, you'll lose 10% of the value of that bond fund. And so those are things that as investors, we've got to be wary of, not only about the future value of our money against the inflation rate, but also as rates go up, interest rates go up, the value of our bonds can take a dive, and nobody likes to see that, but you need to be aware of that as you begin investing in this year 2021.
Well, John, we still like fixed income as a component to someone's portfolio, but maybe more diversification, looking at alternatives to fixed income might be a wise thing to do.
Absolutely.
That is a look at the fastest 4 minutes in investing. We thank you for watching on social media and listening on the radio side. The Get Ready for the Future show continues right after this.